Hey, welcome. Have you ever wondered how people really build wealth? I mean, how they turn a little bit of savings into something, well, significant? Today, we are pulling back the curtain on one of the most powerful ways to do it. We're going to completely demystify the stock market, breaking it all down so that anyone, and I mean anyone, can get it. So let's just dive right in. So let's start with this big question, right? How do the wealthiest people out there actually build their fortunes? Now, sure, a high paying job or a successful business, that's definitely part of the story, but there's usually this powerful engine working for them in the background, making their money work for them 24/7. And yeah, you guessed it, that engine is the stock market. Now, I know it can seem super complex or maybe even a little intimidating from the outside, but really, at its core, it's this incredible tool for building wealth that's accessible to literally everyone, not just the super rich. Okay, so to make this all crystal clear, here's our game plan. First, we're going to cover what the stock market even is, then, how you actually make money with it. We'll go over some key vocabulary so you know the lingo, then some really smart strategies for beginners, and finally, we'll lay out the exact first steps you can take. All right, first things first. What is this thing we call the stock market? Let's just strip away all the complicated jargon for a second and get right down to the absolute basics. So, in the simplest possible terms, the stock market is just a giant marketplace. Seriously. But instead of buying and selling, apples or cars, people are buying and selling tiny, tiny pieces of ownership in public companies. And these little pieces, they're called shares. And check this out, this is the perfect way to think about it. Imagine there's a local pizza shop and it's worth 100 grand. Now, to grow the business, the owner decides to split it up into 1,000 equal shares. So let's say you come along and buy 100 of those shares. And boom, just like that, you are now a part owner. You own 10% of that pizza shop, which means you own 10% of every pizza sold. That's exactly how it works for huge companies like Apple, too. So you might be wondering, why does this whole thing even exist? Well, it's pretty simple. It really serves two sides. For companies, it's a way to raise money, you'll hear it called capital, so they can grow, invent new things, and hire more people. And for people like you and me, it's our chance to invest in those amazing companies and get to share in their success as they get bigger and better over time. Okay, now for the big one. This is the part everybody's curious about. You own a piece of a company, so how does that actually turn into money in your pocket? Well, there are two main ways this happens. So on one hand, you have what are called capital gains. This is the classic buy low, sell high idea we've all heard of. You buy a share at one price, and if the company does well, its value goes up, and you can sell that share for a higher price later on. Simple. The other way is through dividends. Now, this is pretty cool. Some companies, usually big, stable ones, will actually share a slice of their profits directly with their owners. That's you, the shareholder. It's kind of like a little cash thank you that shows up in your account just for owning the stock. So let's put some real numbers to this capital gains thing. Imagine you buy one share of a company for 150 bucks. A year goes by, the company does great, and now that share is worth 180. If you sell it, you've just made a $30 profit on that one share. Now imagine you owned 10 shares or 100. You see how that can add up? But, and I really have to stress this, it is not a one-way street. It is not a guarantee. Just as prices can go up, they can absolutely go down too. There are no sure things in investing, and that possibility of losing money, well, that's what we call risk. All right, so to really navigate this world, you got to know a little bit of the lingo. It's like learning a few key phrases before you travel somewhere new. So let's cover a few essential terms so you can speak the language of the market. You are going to hear these two all the time. A bull market is when everything's generally going up, people feel good, investors are optimistic. A bear market is the total opposite. Prices are falling, and investors are getting kind of fearful. And here's the easiest way to remember it. It's actually pretty brilliant. A bull thrusts its horns up, and a bear swipes its paws down. Simple, right? Okay, now this next idea, this might be the single most important rule in all of investing, especially for beginners. It's called diversification. And really, it's just the wisdom behind that old saying, don't put all your eggs in one basket. By spreading your money across lots of different companies, you lower your risk if any single one of them has a bad year. So you're probably thinking, okay, how do I do that without buying hundreds of different stocks? Well, take a look at this number, 500. That's how many of the biggest, most successful companies in the US are tracked by something called the S&P 500 index. And get this, by investing in a fund that just copies that index, you are instantly spreading your money across all 500 of them. Instantly. And the tools you use to do that are called ETFs, which stands for Exchange Traded Funds, and mutual funds. Just think of them as a pre-made bundle of stocks. You buy one share of an S&P 500 ETF, and it's like you just bought a tiny little sliver of all 500 of those companies at once. It is by far the easiest way for a beginner to get that instant diversification we were just talking about. Okay, so we've got the basics, we know the lingo, now let's talk strategy. What's the actual game plan for a successful start? Here is a simple, proven playbook that works. And hey, don't just take my word for it. Listen to this. The investing legend himself, Warren Buffett, has said that for most people, the absolute best thing to do is to just regularly invest in a broad index fund. He says even a know-nothing investor can beat the pros this way. How cool is that? So here it is, your 3-part starter playbook. Number 1, invest in those index funds we talked about. You get instant diversification and lower risk. Number 2, use something called dollar cost averaging. It sounds fancy, but all it means is investing the same amount of money on a regular schedule, say $100 every month, whether the market's up or down. And number 3, think buy and hold. This is a long-term game. We're talking 5, 10, 20 years. You're not trying to get rich overnight. Now, just as important is knowing what not to do. So please avoid these common traps. First, don't try to be a day trader. It's a recipe for disaster for beginners. Don't go chasing hot tips you hear about. Don't invest any money that you're going to need in the next few years for a big purchase. And maybe the most important one, do not, I repeat, do not panic and sell everything just because the market has a bad week or a bad month. All right, we have covered so much. We've gone over the theory, the language, the strategy. Now it's time for the final and honestly the most exciting part, how to go from just learning about this stuff to actually doing it. Here it is, your simple 5-step action plan. Step 1, open a brokerage account online. It's super easy, just like opening a new bank account. Step 2, link your bank and transfer over whatever amount you're comfortable starting with. It can be small. Step 3, do a little research on a broad market index fund, like one that tracks the S&P 500. Step 4, take a deep breath and make your first purchase. And finally, step 5, the easiest part. Just commit to that buy and hold strategy and let time do the heavy lifting for you. And that's it. You now have the fundamental knowledge to get started. You understand what a stock is, you know how the market works, and you have a smart, simple strategy to follow. The path forward is actually way clearer than most people think. So really, the only question left to ask is, what will your investment journey look like?